and welcome to the panel discussion on the state of tech in Africa. We touched on a couple of things in the previous keynote, so I hope this panel will be a moment for us to unpack that a little bit deeper. My name is Jade. I'm from 274 Investment Managers, and together with one other person, I'm leading investments into our venture capital fund. And I'm thrilled to be moderating this panel this morning. With us, we have a distinguished group of experts in the room, which I hope you're all excited to learn from. And they've got lots of experience and knowledge of the funding and startup landscape across the continent. But I'm going to hand over to my panelists to introduce themselves. So maybe we'll start here with Janice.
Thank you, Jade. Yes, I'm Janice Johnston, and I'm CEO of Edge Growth Ventures, which is an SME investor across 7 different funds, and we've been operational for about 15 years.
Hi everyone, I'm Bakang, principal at E4E Africa, is a venture capital fund based in Cape Town, and I'm responsible for deal flow at E4E.
Morning everyone, Axel, co-founder and CEO of Auto24.Africa. We buy and sell used cars in 5 countries in Africa, a bit like we buy cars here. And I'm also an active business angel in more than 50 startups in Africa and other emerging markets.
Hey everybody, my name is Trisha. I'm the MD of Paymentology South Africa. I'm also part of the co-founding team of Tutuka that eventually became Paymentology, and we're about the largest prepaid card issuer on the continent and live in 50 countries. A part of the team that had 2 investments and full acquisition in 2021. So I'm very excited because I'm passionate about fintech and also startups.
Morning everyone, always a pleasure to be back on the Africa Arena stage. Andrew Dodge from E4E Capital. We're an early stage climate tech fund. Most of our team based in Kenya, I'm based in South Africa. We, across our 2 funds, have invested in about 30 companies since around 2015, so quite a lot of experience across a variety of different markets, and as always excited to have these conversations about the state of tech in Africa.
Awesome. So I think we've got a mix of some entrepreneurs, founders, and some investors. But to kick things off, maybe we could hear a little bit about what your guys' perspective is on the latest funding trends. What are you seeing in terms of the venture capital flows? And I guess what excites you about some of those trends? So maybe I'll start with Trisha from a founder, entrepreneur perspective.
Sure, thanks, Jade. So I think we heard already quite a bit about this from our previous keynote address around these types of trends. So without sounding too much like an echo, I guess the first thing is to address the elephant in the room is that funding has slowed down in 2024. I think the number is around 25% as comparison to 2023 numbers, which I guess is not great. There are a couple of other trends we've also seen, and again, alluding to what was mentioned, is that foreign investment as opposed to African investment is still leading the charge, with North America at the highest. Again, given the changes in geopolitics, it is something that we would have to watch. But it also gives an opportunity for a lot of African funds in order to kind of capitalize on some of this movement. Similarly, I guess the world that I'm in, which is fintech. Fintech still leads the charge in terms of funding. It continues to grow. However, we have seen the rise of climate tech and AI. AI, I think, reaching around 13% in 2024. And again, bring it back to the continent itself. I mean, it's not all bad news. We saw the rise of 2 unicorns come in last year, namely Time, in South African-based digital bank, and MoneyPoint out of Nigeria. So in terms of 2025 and going into this year, investment has already improved. I think January we saw a big month, I think the largest since 2019. So it is kind of seeing a turn, especially in the amount of fintechs that are coming up, and I think it will continue to grow during 2025.
So we've got a founder perspective, and maybe we can switch it to the other side and get an investor perspective. Bakang, what's your views? What are you seeing?
Yeah, thanks, Jade. So I think Melvin's keynote was great because it set the scene in terms of the data, and I think we're all on the same page there. And Trisha's just touched on it now, that we are seeing a capital-constrained environment insofar as the tech ecosystem on the continent is concerned. From an investor standpoint, I actually think necessity can breed innovation, and I think E4E is a case in point in a few investments that we've done recently, where we've looked at blending different structures together. We've looked at some secondary investments, and I looked at some of the data this morning around sort of the capital stack in terms of from 2019 to 2024. Initially, equity investments had been predominant in the ecosystem, and as investors, primarily international investors, pulled out post 2022, there's been an uptick in grants and awards, prizes that have taken up that space. Interestingly enough, debt, and Melvin touched on this when you mentioned sort of the upcoming venture debt as an instrument, it actually hasn't moved that much as a contribution to the investment ecosystem. So hopefully, and I've heard some conversations with a few investors that are thinking about putting together some debt funds to sit alongside equity. So I think that could be an interesting development and an innovation that I expect to see. So we're seeing lots of innovation. We're seeing a lot of collaboration as investors on the continent. So it's an interesting time.
Thank you. So this
Jade, can I just add one point running
please,
off what Bakang was saying, kind of on the same thread? I mean, I think that point is almost exactly right. Like, we've been in this time for the last, I'd say, 2 years where we really have had a fundraise winter, right? And so there's been a lot of constraints on capital coming into the ecosystem, the kinds of companies that have been funded, a lot of closures of some big logo names that we've seen in South Africa, Nigeria, other big markets. And I think at the same time, what's going to be really interesting to see over the next maybe 12 to 24 months is going to be what I think this jump from seed to Series A really looks like, right? So there's a lot of activity. I mean, Melvin had a great slide about all the really early stage funds that are quite active, 25 plus 30 deals in a year, which are smaller checks, writing these really quick deals to catalyze growth, which are really important. But where we haven't really seen such a good conversion rate is from that like seed to Series A, where some of the bigger Griegers and the Partex of the world who are coming in at the A and let's say the late A and early B stage are getting a lot of conversion from that. And I think what this time of capital constraint is maybe teaching us as an ecosystem is that as investors, and I think particularly as founders as well, when we're thinking about how we're building our businesses, the kinds of capital we're attracting, that we really need to get really smart about making sure that we're bringing the right people around the table, whether that's in co-investors or the kinds of funds that we're working with, to ensure that we can increase that conversion rate such that we're getting more success into those A and B rounds. That's going to create that kind of continuity that we need to see in the ecosystem that ultimately is going to end up with some exits for some of us who have been fund managers, let's say, for like 10 years or so. Right now, first funds are kind of coming to the end of their life. So I think I have no particularly strong view as to whether the next year is going to be like an uptick. I think it might not be potentially, but I think what is going to be interesting is to see how this particular piece and this segment of the market evolves over the next 12 to 24 months.
Yeah. I just want to come back to something that Trisha touched on a little bit, which was around sort of local investors versus international investors. And I think it was also touched on earlier in the keynote. But so the venture capital flows are really driven by local and international investors. And so I'm wondering maybe what the panel thinks the role of either of these two parties are. And maybe I can ask Axel for your view.
Yes, so basically there's been, during the golden years, a lot of international investors, especially those American investors, the Y Combinators, etc. If you just look at Y Combinators, they've been stopping investments in Africa over the last few semester, and they invest with 2 cohorts per year, and that's kind of a trend. So it's shifting. First, you see locally more local investors investing, more local funds or funds dedicated for Africa, etc. Like we've seen once again with Brega, Partech, Django, and guys like that. More local investors after popping in as well. I've checked, there's about 100-something angel networks in Africa. So you have in each country, then you have in the big cities, then sometimes you have for women, etc., for specific industries. So this is growing. And then, so I'm based in Dubai myself, and I travel a lot in the GCC, and there's more and more investors coming from this area as well. Why? Because of a few factors. Of course, it's not the same crisis that they're experiencing there compared to Europe or the US. They have a bit of money. They're still flowing oil into the market. So they're reinvesting. So first, they're investing a lot in infra projects. You see more of these Emirati, Bahraini, Qatari, or Saudi investors. They do like infrastructure investments, etc. And then as well, you see more appetite with the tech ecosystem. And then we can talk about like for small angels, they can put like a few $100,000 checks there and then, or more sophisticated one with bigger funds. So it's a bit shifting. After, just to be back on the global state of the tech in Africa, there's also all the numbers that we can't see. All these reports are declarations. So first, there's some stuff wrong there. There are some companies that will say they've raised 100 million, but they don't raise the whole 100, etc. Let's talk about the Market Force back then, or the Wasoko and all these guys. They declared the big funding, but eventually it was not the case. And then there's all these startups that have not disclosed it. Ourselves with Auto24, that's the case, for example, because we can't disclose it from our investor perspective, and all the others. So all of that, the market is probably bigger than what it looks, but yeah, so there's always numbers hiding behind the numbers here.
Thank you. Andrew, do you have any thoughts?
Yeah, sure. Happy to add something. I mean, our fund is, both our funds predominantly and very gratefully backed by international LPs and DFI LPs, and kind of reflecting on, I think, the last couple of weeks, you know, what we've seen happening in the US as that kind of situation has been evolving, and with the withdrawal of USAID from Africa and the kind of knock-on effect that that's had across the continent. I think what that has also highlighted that whilst, you know, international capital has had a massively important role to play in catalyzing the sector over the last decade, let's say, and of course, you know, to Axel's point, like we really need that capital to continue flowing. We are kind of exposed to a certain extent to the, you know, political movements of the time, right? And so we're kind of starting to see a bit of a retreat from places in the West, some parts of Europe, where traditionally these buckets of capital would be allocated to Africa, where, you know, some questions, whether rightly or wrongly, are being asked of, hey, shouldn't this money be used more internally? And we've kind of seen America take quite an extreme example of that. But I think this has been a trend that has been kind of slowly growing, particularly in Europe for a while, and we I think are starting to see some of the pullback. And I think the implication for us as a local ecosystem really is that we really need to be doubling down our efforts on catalyzing some of the local funding, whether that's through, you know, university endowments, government support, etc. I think South Africa is doing a really great job at starting to mobilize some of this money, as well as a couple of other parts of the continent. And I think, you know, if you think about the history of venture capital in somewhere like Silicon Valley, right, the role of government was really, really important in getting these local markets going. And I think, you know, if anything, if what's happening in parts of the West is something that we can learn from, is that this is a sector that, and this is a segment of capital in the market that I think really needs to drive its support for this ecosystem, making sure that, you know, LP money can be put with good GPs and that can put money to work in the ecosystem, that can support, you know, the ESOs, incubators, accelerators, and things like that, to ensure that the capital that's locally based, that understands the challenges and the kind of consequences, can be put to work in the right way. And so, yeah, whilst I think the exposure to some of that fragility is there, I hope that it is an opportunity for us as a local ecosystem to kind of look more broadly.
Yeah, and after the last part is, as Melvin was mentioning, is also the liquidity. So it needs to be liquid at some point. I mean, everyone here, investor, etc., they're there to make money. I think that was the key word missing at the beginning. Yes, you're on a journey, you're fixing a problem, etc., but founders are here as well and investors to make money at some point. And then it creates all these, what we call those mafias, those ex-founders or investors from, let's say, Paystack, Flutterwave, all these guys. They will reinvest into the ecosystem. They will bring their friends in, etc., etc. So it has a virtuous circle effect. So yeah, there need to be more liquidity, secondaries, exits, etc., and that will push back more capital again into the market. Yeah.
Thanks. I think just on what you said about the local investors, I assume that we're trying to be more intentional. I mean, the government, in the budget speech, they started allocating a big portion of the budget to venture. So let's hope that, I guess, that continues. But just on what was spoken about earlier, which was debt as an alternative source of funding compared to the equity, the keynote mentioned it. I think, Bakang, you mentioned it earlier when you touched on it a little bit, but there's been an increasing appeal of debt financing for startups. And so what sort of debt financing trends have you guys experienced, especially now in the context of an economic downturn? Do you expect to see dramatic changes for that asset class, or do you expect to see, I guess, more subtle shifts around debt in the coming years? Maybe Janice, I can give that one to you.
Thanks, Jade. Yes, it's very interesting when you hear a sort of common theme across speakers, which makes you think that you're onto the right track. But we've certainly done quite a bit of research on this, and while Bakang is correct in terms of the actual amount over the last couple of years, what we've seen is that the venture debt space has been more resilient than equity. So it's actually making up a greater portion of capital provided to African tech startups over the last couple of years. So, for example, in terms of a Partech study that was done recently, in 2019, venture debt comprised just under 19% of the overall capital provided to the sector, and whereas that has increased in 2023 to just on 34%. So that's a significant broader contributor to this particular space, and it's certainly shown its resilience in this downturn. And I think a lot of that is due to the adaptability of the space when some of the venture capital funding sources contracted to the extent that they did. The sort of broader ecosystem needed to step in a different way. And the benefit of the venture debt product is that it sort of takes out the valuation discussion, which can be quite challenging to sort of meet expectations between founders and investors. And equally, it has the attraction of being non-dilutive to provide further runway than perhaps the founders would be able to get purely on an equity basis. So it definitely seems to be filling a niche, and I do expect that to continue. We're actually busy raising a venture debt fund, and we are getting quite strong appetite from other LPs in order to deploy into this space. I think it will have a particular use case. I don't see it as a silver bullet for the sector, and I think one of the really interesting and encouraging signs is the proliferation of different instruments and different use cases across the board, and I think this is an indication of the maturing of the industry to a certain extent. So in certain instances, a revenue finance product may be much more relevant to the size and stage of a particular business, or some sort of convertible loan and other kind of blended finance type options that are starting to come into the market as well. So it's very uplifting, and I think something that we can really be proud of that there is this sort of growing number of options for SMEs and VCs at this stage. And so I suppose the encouragement there is to ensure that you get the right fit of the funding product for your needs. And given the fact that all of these products at this stage represent some form of equity profile risk, that there is equally this contribution to more than just funding, as has been alluded to in previous talks, that all of these come with a real post-investment support.
So you spoke a little bit about different instruments, debt's one, equities one, and then SAFE is, I guess, something that maybe has been coming up a little bit more. So Andrew, I don't know if you have some thoughts, not shorts, to share around that. Anything specific you've been seeing around SAFE notes? I guess that also takes out the valuation conversation at the moment. So what's your experience been around
Yeah,
SAFE?
it's an interesting and I think quite a timely question, because I think the role that SAFE notes have and will continue to have across the continent in terms of funding startups, I think also there are a lot of interesting conversations going on at the moment, right? I mean, I think we saw off the back of this kind of instrument coming out of the US, providing a way that a lot of startups could get funded quite quickly, particularly during this kind of liquidity crunch, where maybe as investors we didn't necessarily need to do a lot of the hard work in terms of answering those valuation questions, and it's kind of kicking that can down the road. But I think we're kind of at the point now where the can can't really be kicked too much longer, right? And so we're starting to see, or at least for us as a firm, looking really quite hard at companies who have raised SAFEs in the past. I mean, we've seen some examples of where founders have stacked SAFE upon SAFE upon SAFE as just a way to kind of keep things moving forward, not really working out well in terms of things like governance rights, the cap table becoming kind of completely wonky and skewed, not really being able to do the job that it needed to do, right, which is actually enabling enough liquidity to be there for the next round, right? That being said, I think they still do have an important part to play, particularly at a much earlier stage where checks can be written much smaller and quicker, but then maybe not so much for our kind of institution any longer, which we kind of, if I think about our role in the ecosystem, right, we're coming in at that slightly later early stage, if that sort of makes any sense, where our job is to kind of come in as that first bit of institutional capital, demonstrate some of those commercial proof points that can hopefully get that company towards like a much more mature A or a B stage. And I'm not convinced any longer that SAFEs really should be playing in that kind of world. We've seen a lot of them there in that kind of seed and post-seed space, just because I think that the nature of the instrument isn't aligned to doing what we think our role as a fund should be, which is very active, involved in creating value, involved in making sure that those milestones to the next fundraise are there, right? And I think, to Janice's point, I think where debt can come in, and again, not appropriate for every company, and you need to think quite strongly about whether it is appropriate. I think debt has a really, really important role to play in demonstrating a lot of those commercial points, which obviously is a whole lot cheaper than equity, even though it might look at it. So yeah, I think the safe question is one that's going to continue on for a little while, and I think is hopefully going to find its place in the funding stack over the next little while quite nicely.
Okay, so we've spoken about equity trends, we've spoken about debt trends. I think another hot topic is around gender. And I think for the past couple of years, there's been a couple of initiatives that have come up in the ecosystem on both sides. One to support female founders, but then also to support female fund managers. And so maybe to the ladies on the panel, given its gender. What has your experience been around gender? Has some of the initiatives that have come up in the past couple of years, have you seen that as being meaningful, or is it just something that people can say, hey, gender, because it's a buzzword? Trisha, yeah, you can go first.
Okay. Yeah, and this is a very relevant topic, I think. So having started out in fintech, and I know I look very young, 20 years ago, I can tell you what the boardrooms look like, walking in there, being a female and being a female of color. it has been very different back then. So we have definitely seen some movement in that. However, it's just not enough. I mean, some alarming statistics for everybody in this room. If you think about it, in tech in Africa, only 28% of the workforce are actually women. If you look at founders and entrepreneurs in Africa, 17% are women. Perhaps the most alarming statistic is that the gap between men and women who have access to the internet is 37%. So these numbers are real and they're happening right now. So a lot can be done to actually encourage participation, especially in the fintech environment. And I think it's up to a couple of things that can be done or should be changed. Government participation. So governments need to encourage more boardroom engagement of women. And there have been cases where governments are forward-thinking, where they're offering incentives and sort of policy changes that allows for more women into the ecosystem. But I think there's a lot more that can be done from that perspective. At the same time, the access to education. MasterCard recently did a report, the MasterCard Foundation did a report on STEM, and they found that young women or young girls and boys had the exact same passion for it. They were all interested in it. But as females grew older, and because of the pressures and a lot of societal changes, culture, they ended up dropping off, and which is why it's skewed towards guys. And in this regard, I think if there is more of a targeted approach to young girls and things in the form of bursaries, more actual funding around it and opportunities, then we can actually grow more women in the workforce of tech. Finally, I think it's up to all of us women that are in tech themselves. There's a lot of organizations, there's a lot of support groups. I'm part of Women of Payments, where we support founders and actually, applaud leadership. But a lot more can be done in that space when it comes to actual women supporting women. And finally, I think corporates and techs themselves can do a little bit more when it comes to encourage women, especially supporting them in order to get them into leadership positions. I'm a mom. I know how difficult it is balancing a career and kids and family and all those responsibilities that come from being a woman. And in the corporates and tech space, if there are forward-thinking environments where you think about things around flexibility for women, the opportunities that come with maternity space, training and education, especially when it comes to supporting their kids, I think we'll see a lot more women ascend to positions of leadership in those types of spaces and environments. But yeah, that's my opinion.
Janice?
Gosh, that was a wonderfully comprehensive answer. But if I can just add a couple of things, I do think there has been some improvements over the years. Definitely not enough, and definitely not at the pace we would expect. So there is an acceleration required in terms of access to opportunity and also to raising visibility of certain role models. Because for a lot of women, if you can't be it unless you can see it. And so really this sort of understanding of what it takes and what a future could look like in these kind of environments is very important from an education perspective. And it probably needs to start a bit earlier than perhaps some of these initiatives are currently sort of focused on to really sort of cultivate the pipeline of women into these important industries. There have been a number of initiatives on both the sort of founder side and the fund manager side, but it's still quite tinkering around the edges, one feels, and so on. And still there's a sort of a sense that, we're still in pilot phase almost for some of these things, and it needs to perhaps translate into more mainstream and almost taking the gender angle out of it, that a lot of these funders and a lot of the research has shown are really good at it. And so therefore, their experience and their track record should speak for themselves to be able to access additional pots of capital to keep deploying into these spaces where often the sense of different kind of thinking, more diverse environments are best suited to make complex and sort of layered decision making.
Yeah. Yes, we love to hear from the men.
Yeah, on this question as well, I think the women, we have of course a big role to play because we need to push it. So just give my personal example, but same thing with cars, with Auto24. If you're a woman anywhere around the world and you go to a car dealership, it's mostly male-dominated, male seller, etc. But why? Doesn't make sense. It's not because those cars are, very complicated or whatever. Myself as well, I don't know a lot about cars. I know about the business, but not cars themselves. We have mechanics. So yeah, we've been hiring women in our dealerships, especially the one we have here in Johannesburg, and more than half of them are women. They over-exceed in terms of sales. They just do it better than the men we have in our team. And the country manager as well, now she's a woman as well. And it's different because if once again you look at all the dealership, and South Africa is a country full of car dealerships, it's mostly men. And yeah, I think, so it can be changed, but it's, as you said, an action from everyone in the tech space as well. Just make it more diverse, etc. It will bring more good stuff to the business, of course. So
Yeah, okay, so there's things that are happening, not at fast enough a pace, but we'll keep them going. And it's everyone's responsibility to sort of play their part. So switching gears slightly, there's been a lot of cross-border collaboration and regional sort of integration. And maybe from an entrepreneur, so maybe Trisha, I can give this one to you. How do you think that the way SMEs are sort of funded now will change in the next few years in terms of scaling and cross-border collaborations? What has your experience been around that?
So speaking from a payments and fintech background, I can tell you that, payments make up about 40% of the continent's total GDP. But again, it's very fragmented. It's extremely difficult to do cross-border work and get things working in multiple countries. A typical example that everybody would be aware of is like Safaricom, and it's prolific, or in Kenya, yet achieving that kind of scale in other markets has been difficult. And there are a number of reasons around this. I mean, there's lots of different stuff around regulation and different government requirements within countries. There's cultural differences, there's infrastructure difference, there's actually just costs involved in kind of creating scale in lots of different countries. So I think collaboration and partnerships become extremely important, especially if you want to reach scale across different regions. And if I look at again, going back to the background of fintech and payments, there's a lot of collaboration done when it comes to the schemes themselves, MasterCard and Visa, even UPI getting involved with a lot of fintechs and payment providers in order to be that collaborative partner that allows you to actually go across country and help you with regulation and some of the difficulties in setting up offices in multiple locations. In the same vein, we've seen that with traditional players that have partnered up with fintechs. So there's a lot of regional plays from banks that have then partnered up with some of the big fintechs. You've got Flutterwave doing things from a cross-border perspective, similarly on Afrique. So there is definitely opportunity in order to partner up and collaborate around the region to foster growth in those different countries. And then if you go back to your question around SMEs themselves, yes, SMEs are extremely important. 95% of all businesses in sub-Saharan Africa are SMEs. But out of that, 40% of them say their biggest struggle of growing is actually funding. So and with funding in the SME space, there's an element of risk. So in terms of where I see it could go to, I think there is a lot of opportunity in terms of blended financing when it comes to SMEs in particular. And that's like looking at a mixture again for government getting involved, private sector, public and philanthropy in order to grow and scale some of these SMEs from a funds perspective. But yes, to answer your questions, partnerships are extremely important. They allow you to reach scale, especially if you're partnering up with local environments or large regional players that get you into countries. And two, from an SME perspective, financing, look at blended financing options.
Thank you. I'm being told that we are running out of time. Do we have time for questions? No questions. One. Maximum of 2 questions. So I'll open up the floor to the audience. Any questions? Got a hand over there. Can we get a mic?
Panel, fantastic panel. Thank you, panelists, for all coming through. Just a very simple question. With Trump forcing the Europeans to increase the defense spending, potentially crowding out development funding, there's a real risk of a diminishing amount of capital coming into Africa, at least from a new capital perspective. And a big question that's being asked within the entrepreneur founder circuit is, we're seeing a lot of deals getting done, new capital coming in, at least from the last 5 years. What are the themes around exits and liquidity? Because there's a risk here we may have to rely on liquidity to recycle, which will be utilized to recycle to continue funding new opportunities. And one of the things I'm not hearing and I'm not seeing a lot of is discussions in terms of exits, liquidity, and particularly returns back to LPs. And obviously on the back of those returns, then they may have the appetite and the capacity to reinvest into the sector. So if you don't mind, can you just have a little discussion in terms of the exit environment, the key themes around exits, and obviously from a founder perspective, the exit is how we make our money. So if you can just guide us upon that, I'd really, really appreciate that.
I'm happy to wade into this one, which I think probably needs a whole panel in and of itself. I mean, I think to your first point about what's happening politically, I think if anything, what's happening in the West is probably only just highlighting an issue that is coming to the fore, and I think is increasingly so over the next 12 to 24 months, given kind of where we are as an ecosystem, right? So a lot of the funds that closed in, let's say, like the early 2010s, 2013, 14, 15, around there, which is the vintage of our first fund as well, right? They're kind of coming to the end of their life if it's a typical 10-year kind of fund structure. And so these questions around liquidity, I think, are coming up regardless. And I think the next 12 to 24 months are going to be really, really important for demonstrating effectively what should be the full proof point of this ecosystem, right? The ability to raise capital early, cycle it through the full fundraise cycle, and then provide some kind of return of capital to those investors, right? Whether that's from the early stage all the way through to some of the later sort of A and B investors. And so, I mean, I think maybe it's not being spoken about directly today, given we touched on a couple of other stats, but certainly it is in the minds of us as GPs, particularly who've been investing on the continent for a while, that this need to start to return capital is really important. I think what if we kind of look back at some of those fundraising graphs as well, right? We saw a real big ramp up towards COVID and actually sustained itself kind of through COVID, and then this kind of drop off in fundraising, right? That similarly had a knock-on effect, I think, to some of the valuations that we saw, right? There were potentially some companies that were raising a lot of capital, potentially too early, potentially at high prices, and what we don't think about, or what hasn't really been, I think, considered that well at those times, is the effect that has on realizing liquidity later on, right? If valuation is too high early on, it makes getting those multiples later on much more difficult. And so I think as a part of these discussions, as we kind of look forward, some of the perspectives that potentially some founders need to have is around resetting some of those pricing expectations, particularly early on, right? Resetting some of those multiples of where we're raising capital, how much today, from who, such that we're ensuring that we're creating that kind of sustainability of path towards liquidity for the funds. funds. And so, yeah, I mean, I think it's a super interesting discussion. It is certainly forefront of mind for a lot of us. I don't know if anyone else on the panel has any thoughts about it, but yeah, those would be mine.
Yeah, just a quick one. Where we have seen some successful exits, although possibly not at the sort of multiples returns that one would like, is through trade sales. In other words, integration of some of the innovation engines that the SMEs have created into larger corporates. But obviously that sort of integration and the price that they're willing to pay is not necessarily the same as further funders down the line. But again, it's sort of the sense that the market does sort of create some kind of opportunity sets dependent on the need, even if it's not quite, as I say, as at the valuations that they were hoping for, but it is providing an element of liquidity in a positive sense to the funds.
Thanks, guys. Thank you for the question. We won't be able to take any more questions, but the panelists will be here during the course of the event, so if you have questions, you can grab them at some point. But I'll wrap it up over here. Thank you to our panel. Maybe you can give them a round of applause. Thanks, guys.